Hello everyone, welcome to the third session of the Oliver Kell Masterclass. Today we'll be focusing on super performance setups. Oliver, if you could go to the next slide. Just to start things off, here is a disclaimer. Obviously, please do not reproduce this content in any way, shape, or form without express written permission of Traderline or Oliver Kell. And here's an overview of kind of the entire masterclass. Oliver, if you could go to the next slide. Today we are on session 3. Session 1 and session 2, if you're just joining us for this one, are completely recorded and archived for you to watch as many times as you want in the course module. And today really the focus is on entry setups, entry tactics. Oliver will be sharing the specific setups that he uses every single day to identify the best opportunities and manage risk. And we're really focusing on entry setups today. So next session will be sell rules, risk management, position sizing will be down the line. So please keep your questions focused on entry tactics, entry setups only. That's really gonna be the focus of this webinar. And like the other two, this will be 100% recorded. So if you need to step away or if you can't make the whole thing, don't worry. I'll try to get up the recording on the website as soon as possible. We'll actually be adding, I've announced this before, but we'll be adding a 5th webinar just to spread out the material a little bit more. And yeah, that will now be on December 18th to finish things off. So with that, I think we can move on here, Oliver, to the next slide. And yeah, it's my pleasure to introduce Oliver Kell, the U.S. Investing Champion of 2020, your teacher for this session. Oliver, the floor is yours. Welcome.
All right, thanks, Richard. Welcome back, everybody. Looking forward to going through session 3 here. So let's just hop right into it. This first slide, I've named the pivotal point. And I think this is key. I actually think a lot of the other stuff in here, you can read and learn about in books, and you obviously can here, but I really want you to take away the point of this slide. So just a quote here to start things off from Jesse Livermore from the book, How to Trade in Stocks. Highly recommend you pick that up and read it. It's a great read. But he says from page 31, whenever I have had the patience to wait for the market to arrive at what I call a pivotal point before I started to trade, I've always made money in my operations. So with everything that I'm doing, with the different patterns I'm going to go over today, with the wedge pop and the price cycle and all that, really is what my goal is to give myself a point on the chart where I think the price action is going to react a certain way. And if it reacts that way, my analysis is correct. And if it doesn't react that way, then I view it like I'm wrong and I want to get out of the market. So that's key. Like with all these patterns, really the name of the game, in my opinion, when it comes to charting and analyzing the market is, learning through experience and applying creativity to create pivot points for yourself, where you can then manage your risk against. So that's key. And then this second quote, this is something that my mentor said to me a couple of weeks ago, actually. And I think he's said something along these lines, probably a million times to me over the years. But this is gold right here. You, nor I, nor anyone have any idea what's going to happen. It's why I hate adjectives and labels when describing the market. Those words create bias and attract ego, and our minds, knowingly or not, try to confirm that bias all the time and prevent us from acting in a position of strength. Scan, find spots, manage risk. That's really all we can do. Our job is to collect clues. When our spots are rewarded, things are good. When they aren't, things are bad. Really nothing else to it. This is gold. Like, I actually think you should screenshot this and put it on your desk. I have. And the reason it's really important to me is because I do have a tendency to have a bias at times. Usually I'm bearish right on the low. It's not uncommon for me to literally be short the market and then flip long, like at the low of the market. And the thing is that, people go on TV and they make predictions, that's what they get, invited on CNBC to do and all these different things. When in reality, it's not about knowing where the market's going to go. It's about finding low risk spots, by taking the skill sets we're going to talk about today, or whatever else it is that you learn on your own, where you can execute and you can manage risk. I mean, that's what technical analysis is all about, is managing risk. People rag on technical analysis, it doesn't work, blah, 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 and they're missing the whole point. The whole point is to literally find an area where you think something might happen, and you can risk a small amount. And if it works, you can make a multiple of that risk. And if it doesn't work, you get stopped out. And then if you get stopped out multiple times in a row, that means a couple things. One, the market's not healthy for what we're trying to do. And that's feedback that you should take to say, hey, I want to, pull back the reins. Or two, you're just not doing things correctly. The way you're analyzing things is incorrect, and you need to kind of reassess what it is that you're doing. But this quote, find spots, execute, manage your risk, and kind of let things play out. So everything we're going to go about today is literally about kind of finding those specific spots. So before I kind of hop into all this, I want to talk about timeframes. So the highest time frame supersedes the lowest time frame. So for me, I like the monthly, obviously, but really the weekly is sort of the anchor of what I'm doing. The daily is what I'm analyzing to kind of fine tune that pattern for the next day, and where I'm really managing the trade, because I'm more of an intermediate term trader. Whereas if you're more longer term, maybe you manage on the weekly, and that's perfectly fine. And then intraday for me is for risk management. So I want to emphasize this here because, this is something that I struggle with sometimes. Do not get caught looking for opportunities on the 5-minute chart. Just don't do it, because you're going to chop yourself up. You're going to take too many trades. I think I've told you guys before, I'm a chronic overtrader. Part of the reason why is, I get caught looking intraday. If there isn't a setup on the weekly or daily chart, there's really no point in looking at the intraday chart. And the reason being is because that trade, it's not going to have legs to really move, unless those higher time frames support a bigger move. And for me, I'm looking for bigger moves, at least a couple weeks. All right. So now let's kind of hop into it. So this is just kind of like a rough, buying checklist. I can't say that I literally go through and check off every one of these as I'm analyzing things, but, I've been looking at charts so long, and, I feel like I've kind of refined what I do, that I am doing this for sure in my head. So number one, and this is usually coming out of a correction of sorts, but is this a major monthly or weekly consolidation? If we're coming out of a correction, we want to be buying patterns that have basis, and actually really all the time. I mean, we want to be buying basis, right? Because a base is sort of that true support for the market, where we can feel good that if we clear this range, we're going to have a move. So then number two is, where are we relative to the 10-week exponential moving average or simple moving average, whatever it is that you use. Don't get lost in the details. Are we extremely extended from the 10-week? Then, buying a breakout is going to be of a lower probability than if we're closer to the 10-week. And also, if that breakout does work, how far is it going to go? Because we're already stretched, right? So I always kind of want to know where we're at relative to the 10-week. Then three is, identify that change of character on the chart, right? You can have a big basing pattern, but if there's nothing saying, hey, I'm ready to move, then it may just continue to base. So identify that change in character, usually representative by volume, in the form of a bull snort or maybe a massive gap out of the base. But then we really want to trade that stock from that point forward. Is this stock exhibiting relative strength? Where are we in the index price cycle, right? So if we've been rallying for 8 weeks or 9-10 weeks, and a stock is kind of just breaking out and it's really been showing relative weakness and lagging that entire move, the likelihood of it working compared to something that maybe literally broke out when the market was putting in a reversal extension on the lows is lower. So you just kind of want to have that in the back of your mind when you're looking at different charts. So we've identified a weekly or monthly consolidation. We've determined that we're not crazy extended from the 10-week, so that if that trade does trigger, we can actually catch a real move. So next, we want to be looking for our daily chart pattern, at least for me. And I call that a pattern within a pattern, right? So maybe we've got like a 6-month base and we're trying to narrow in on a contraction and volatility on the daily, so that we can really try to fine tune when that thing's going to move and better manage our risk. So I call that a pattern within a pattern, and I'm going to show some examples of that. And then subtle clues. So, even within that daily chart pattern, what other clues can we find that can help us, better determine when the actual move is going to begin? Some things that I use: inside bars, which I'll explain what those are. Volume dry up is key. Maybe a very subtle, small, unfilled gap that most people don't even notice, because you kind of have to really look for it. And really is what we're trying to create with the weekly, monthly, the daily, the subtle clues, and really analyzing the different volume patterns in the base as well. Is we're trying to create multiple arguments, or confluence. Confluence is something that I learned from Trader Florida when I was first learning to trade. And it's basically just the idea that we have multiple things saying, this is getting ready for a move. It's getting ready to work. There's people trading the weekly. There's people trading the daily. There's day traders looking at an inside bar for a one-day move. There's a lot of different people looking at this thing that's going to create buying for that stock to move higher. And then, is there a catalyst? So there's not always going to be a catalyst for a stock to move. But I do find that often when you have, say a 6-9 month base or something along those lines, there is something that gets it to push out of that base a lot of the time. So catalysts for me, I would say 99% of the time are earnings. But maybe it's news, maybe it's a new product launch. If you trade biotechs, which I don't, it could be some sort of FDA approval or something along those lines. But if there's a catalyst that triggers that movement out of the base, it just adds another argument for why that thing should work, another level of confluence. So once we've kind of determined our setup, or what we want to be watching, does the potential upside justify the risk? Another way to think about that is, does the risk justify the upside, in the sense that if we feel like, oh man, I need to take a 10% stop on this and I think I can make 20%, that's not a trade I have any interest in taking. But if I think I can risk 3% to make, 30, 40, 50, hopefully even 100%, that's a great opportunity. Because really at the end of the day, we want to be making a significantly higher upside than the downside we're willing to risk. So I think at a bare minimum, you should be targeting, 3 or 5 to 1. But for me, I'll have a couple trades a year that actually kind of make my year, that can be 20 or 30 R. And to be frank, a lot of my other trades are just kind of mush. So those major upside multiple trades are really what's going to help you make your year. So, we definitely want to be looking for that risk reward relationship. And then lastly, is there resistance to the left, or are we at new highs? What are my objectives for the trade? So I think I've talked about, I'm sort of a hybrid in a way. So I will take trades where there's resistance to the left. But usually it's a shorter term swing trade, right? Because, maybe you get that quick pop, but then you're at resistance. And rather than try to sit and fight through that, for me, it's better to just treat that as a swing trade. And additionally, I find when you're trading situations where there's major resistance to the left, that stock is going to need a very, very long-term, 6 to 9 month plus bottoming base for it to truly actually have follow through. Because those holders that are caught, holding the bag, they need time to get bored and sell out of their shares and all that before it's really going to work. So really, you're better off trading stocks that don't have resistance to the left, or maybe they're kind of at new highs and they've just pulled back a little and you're not buying it right at new highs, but let's say you're within 10 or 15% of the highs. And if you read How to Make Money in Stocks, which I'm going to go over, some of the more traditional basing patterns, he'll pretty much show you that most bases do not correct more than 30% if they're healthy. You do need to take that in context. If we go through like a COVID type correction where we're 35% off the highs, you're going to have many basing patterns that are much, much deeper. But generally speaking, that's a rough rule of thumb. And really kind of the tighter the base, the better. Because if you think about it, a tight base just shows that the sellers either weren't as aggressive in selling it off the highs, so there's less profit taking, or B, the buyers were more aggressive in supporting that price near highs because they just liked the merchandise so much. So let's kind of hop into some actual patterns. So
Oliver, before we get going, there are some questions about this.
Oh, sorry.
No problem. So first of all, to everybody asking about the price cycle, the index price cycle, I'd highly recommend you go back and rewatch webinar 1, where that's the sole focus. Today, we're really kind of building off that knowledge, so definitely go back and rewatch that if you're still confused. But there are a lot of questions, Oliver, about how you determine potential upside. And yeah, I'd love to hear you expand on that.
Yeah, so I don't actually use targets myself. We'll go over, kind of how we handle selling on the next episode. But basically for me is I'm looking at where we are relative to the 10 week. And ideally we're, basing around the 10 week and, maybe it's kind of coming up under price, but it's, it's right there. And to me, if we're near new highs and that 10 week is right near there, there's potential for that thing to run a good ways. So to me, that's like a stock where maybe it can run 30, 50, 100% or so. Whereas if we're buying something that's real extended from the 10 week, I'm going to be a little less inclined to take major risk on that thing. Just because by the time it really gets moving, it's going to be so stretched that, it's likely going to kind of snap back or want to rebase again. So for me, kind of that 10 week, and if there's resistance to the left side of the chart, is one of the, the two major determining factors. I think for part 2, is there resistance? One thing you can do is just only trade stocks making new highs. A great piece of advice that I got from a guy I trade with, if a stock is, think about some of these stocks that just go viral on FinTwit or whatever. If they're such great stocks and they're going to go up 1,000, 2,000%, you kind of know how people get hysteric about stocks. Well, they're going to make a new high at some point. So do you really need to catch that first 20 or 30%? No. And this is a guy who's been in the game for 30, 40 years who told me that last year when I was trading Fastly, is he pretty much said, if Fastly is as great as everybody says, you can just wait for it to get to highs. And if it's going to go up another 10x, you're going to do all right. So I think for number 2, just trade stocks that are, not necessarily at new highs, but they're on the cusp of making new highs. And then I think I talked about this last time. I think kind of the sweet spot for new stocks is kind of that 6 to 18 month, maybe 24-month window after their IPO, where if they do get going and they do get moving, anybody buying shares is really a new accumulator, right? Like the Fidelity, the T. Rowe Price, they're actually starting to build their position. So those can be great opportunities because it's new, like they have to buy it, right? And they're not going to spend 2 weeks buying, they're going to spend 2 years buying. Whereas something that's already run and is maybe pulling back, there's certainly stocks like Apple and Tesla that we want to stay on, and they go on multiple runs. Those are Nvidia, those are the true leaders, and we want to stay on those. But a lot of these stocks, like we saw it last year, the Pelotons, the Rokus, etc. They went on their 1.5 year run, and now they're until they're ready to make a new high again, they're just kind of beat up, worthless merchandise, in my opinion. So finding that sweet spot, that 6 to say 24-month kind of IPO, and then also just trading stocks at new highs in general or within shouting distance of new highs that aren't extended from the 10-week, that's going to be the best case scenario for you to have a high upside trade.
Perfect. And yeah, there's also some questions coming in about what does Oliver mean by extended. Again, we talked about this really extensively in webinar 1, so I really won't want to focus today's session on just the entry setups. But there were a lot of questions. I think there's a really good question, Oliver. How far to the left do you look on the chart to determine whether there's overhead supply and resistance?
Sure. So, I mean, really, I would say that if you can see significant distribution to the left-hand side within the last 6 to 9 months, it's probably not the highest potential scenario. I think, kind of potential turnaround-ish type plays, they really work when that stock has even had like multiple years to consolidate. So I think once something has kind of broken down more than 30, well, let's just even call it 40% from the highs, once it's gotten to that level, it's usually, for the most part, kind of damaged goods for a while. And even if it kind of goes back up, I'll show some examples later, but even if they kind of go back up, there's usually just better opportunities to trade. So it's not so much that it's not going to go back up. It's just there's better opportunities until it kind of gets back up near new highs. So that's what I would say.
Perfect. I'm not seeing too many more questions come in on this slide, but I think it's just really important to emphasize number 9, 10, and 4. It's all about kind of awareness of yourself and the potential of the stock. I think that's so important to, especially for new traders, to grasp, being kind of objective and recognizing what should be my objective for this trade based on how far it's come from a proper base, consolidation, all of that. So I think those numbers especially are super important.
Yeah. So, I mean, if you think about it, like the best times to be buying are when we are, we've had a reversal extension, maybe down in the 200-day or the 50-day or something like that. And then the stock's had time to chop out and creates one of these patterns next that I'll be going over. Maybe we're doing a wedge pop through the 10-20 EMA, but we're within shouting distance of the 50 SMA or something like that. Because then just being near that longer term moving average in and of itself, like, we're likely not extremely extended. And when we do trigger the buy area, the wedge pop, enter that kind of upside part of the price cycle, we're going to have room to move to the upside because we've had time to consolidate. So I trade the price cycle in these patterns within the price cycle, but I'm aware of those longer term moving averages, like the 50-day in particular. But the 200-day, I just prefer to trade stocks above the 50-day. But I'm aware of those because it kind of tells me, hey, we're not extended. We've got room to the upside. And if you're going to look for patterns via the 10 or 20 EMA, that 50 SMA is right there to just kind of let you know we're not extended, if that makes any sense.
For sure. And something that stood up within all these sessions and in the mock run throughs for me is, even though you're kind of a swing trade time frame, you've talked so much about how something being set up on the monthly is so important for you, and the monthly time frame is just so important. So I think it's so important to consider the longer term time frame of any stock you're looking at. 100%.
Definitely. And just so you guys know, like I say, 50 SMA or 10-week, they're almost interchangeable in a way. They're about the same. It's more like a point of reference, and then we trade the price cycle around it, just to clarify that. All righty. So I use the IBD type patterns, like the cup and handle, the double bottom base, the flat base, all that stuff. But I also like the more patterns that you guys have probably heard of, bull flags, pennants, descending channels, descending wedges. I think a great book to learn more about these is just a simple book, Getting Started in Technical Analysis by Jack Schwager. I like this book. John Murphy's book on technical analysis is kind of considered the Bible of technical analysis. So you could pick that one up too. But another way you can learn about this is, one thing I did is like Dan Zanger, you go literally back through hundreds of his reports over the last 15 or 20 years, and he's great at showing these different patterns. Highly recommend that. But I'm going to run through them right here, the patterns that I really focus on. So the first one is just a bull flag. So this is a short-term pattern of lower highs and lower lows. It really just marks a contraction in volatility. So if you think about it, we have a nice move higher, and then we have a couple days, maybe 3 to 5 bars, I'll say, where price pulls back, tightens. It's best if it's on light volume. So think about it. We see big buying on heavy volume, and then we see a pullback in a way via bull flag on light volume. It's a sign that people aren't selling their shares. And then when we break out of that pattern, break through those lower highs, it's a continuation of that move. So that's what a bull flag is. This is sort of a diagram of it on the left. The other way that I use this is, I'll often, if you follow me on Twitter or something, I'll say this has a flaggish type look to it, where maybe it's not technically a bull flag, but it's exhibiting, that 3 or 4 days, 5 days of just kind of tight action, lower highs and lower lows, and maybe it's inside of a larger pattern. And when it breaks out of that short-term consolidation, I'll trade it higher. So one thing my mentor calls it, he doesn't call it a flag or anything because he doesn't like to be put in that box as to where it should be on the chart. He'll call it like a 1, 2, 3 pattern, where it's like 1, 2, 3, tight, lower highs, lower lows, and then we move higher. So right here on Cloudflare, so this is a big base, right, on the weekly, or this is the daily, sorry, but you'll be able to see this closer on the weekly. And you can see this is the 200 SMA, the 50 SMA is kind of running right through this base. So we're not extended. We've had a lot of time to base out and build power. So that's really what the base builds, is it builds power for an extended move. And then is what we have here. We have the wedge pop right here. So we pop up through the moving averages. This is your first real buy area. And then to me, this is kind of that flaggish type pattern. So it's a tight consolidation down into the EMAs in the form of an EMA crossback. You can see this is about 1, 2, 3, 4. It's about 5 days, and it's right near this descending trend line. So a trend line should always have 3 touch points. So 1, 2, 3. And then when we push out of it, we're doing multiple things, right? So 1, we've got the wedge pop. So we know we're in the upside price cycle. 2, we're not extended in that we're near these longer term moving averages. 3, this is in the form of an EMA crossback. So upside move, pull back to the moving averages. If you're aggressive, you could even start kind of buying in here. 4, we're triggering this flaggish type pattern. 5, we're clearing a descending trend line. 6, we're breaking out of a major weekly base. And 7, the volume patterns here, right? Look at the volume patterns in this base. So this is very important. When we analyze this base, hold on, Richard, let me get my spotlight thing.
Yeah, that's what I was actually going to ask you, but perfect.
Yeah. So well before this thing even breaks out, look at this positive volume here. Look at this positive volume here. This is one bit of negative volume, but it's almost like right on the lows of the base, and it can be kind of interpreted as capitulation. And then when we tighten here, it's almost like the buyers kind of scoop up that negative volume. And then we start to see positive volume patterns again. So that's kind of number 7, right? So you have 7 kind of pieces of confluence or arguments that say this is going to be a good trade. And then really when we break out of this flag right here, we break out right through here, and we can set our stop right down here. So we're able to get on this trade out of this huge base with a very tight stop. And then, if you guys followed up on this stock, it goes on a fairly extended move. I think it more than doubled. So this is an example of that flaggish type look. And then really a true bull flag is right here. So just this pullback to the moving averages, this is a 1, 2, 3, or a bull flag right into the EMAs. And when we push out of it, you see that volume come in after resting on declining volume right here. And this is more your kind of traditional bull flag that people will talk about. So that's the bull flag. It's just a very short-term consolidation pattern. I want to emphasize that flaggish type look in addition to just the traditional bull flag you're going to read about in books, because often when we're going to break out of a big base, you'll get this short-term tightening action, kind of right under the breakout point. And that is ideal. That is the ideal point to execute where you're going to have maximum upside, but also a tight area to manage your risk against.
A fair number of people are asking if you could clarify about like where you would place your stop loss for this type of trade. And also, I love to hear your thoughts because this pattern, it might just fail and then reset. So I think that's also what we're talking about is, a pattern could look really strong, but it can always fail. You always have to manage your risk, but also be prepared to retake a trade and try it again, even if it didn't work the first time.
Sure, absolutely. So in this scenario, like I just on failure, maybe you could have looked at this little area and tried to buy that there. The one thing I'd say is it's extended from the 10-day. So that's another thing is we don't want to be buying price when it's extended from the 10-day. That O'Neill Disciples book I've mentioned, in the previous sessions, he talks a lot about that is kind of using the 10-day as your guardrail to make sure you're not buying something that's short-term extended. But once we determine our pivot point, which is right here, we want to set our stop. For me, kind of my quote unquote max pain stop is below this, little basing area. And once it, follows through and in this case finishes at the high of the day, I'm putting my stop at the low of that day. Or if you want to give it just a touch more room, maybe below the 10-day here, because the 10-day is right below that bar. And the reason why I'll kind of tighten it up there is we push out of that pattern. And to me, it's like, okay, my reason for buying was a breakout of this, flaggish type look out of this base. So if we reverse and fail on that pivot, from failed moves come fast moves. And my analysis is incorrect. Now, we could squat here for a day or two and maybe not fully push. And it's kind of at your discretion whether you want to try to hold that or not. For me, I kind of take the general market into account when I'm using that discretion. If I feel like the market just doesn't have it, maybe I don't hold the trade. But really, my reason for buying is through that pivot. If we fail back down through it, I'll stop out and I'll look for another opportunity to get long the stock if it sets up again. But once we break out, I want to kind of really start to refine and tighten my stop here. And as we break out and base here, this day here, and then head higher again, that's kind of when I'll even get my stop to break even to make sure that I don't take a loser. And then when you get that, first true pullback, more than just a basing day, but a pullback like this, that's when I'll start to kind of trail my stop up with the higher lows. And we're going to talk more about that on the next session, managing a trade. But that's kind of how I'm managing my risk initially. So kind of below the pattern, then when we break out, really kind of below the breakout day. And then as we work up, I want to try to get my stop to cost because that's really my whole goal is to just manage that initial risk. And then from there, it comes down to managing the trade.
And there was a question about why you're not super focused on buying the wedge pop at the bottom of the base versus the EMA crossback here, and the full bull flag.
Because it's an example of a bull flag.
Yeah, there you go.
I would ideally you're buying the wedge pop. This is just a bull flag example, so I'm trying to focus more here.
Perfect.
but yeah, ideally you buy this wedge pop and you use this as a pyramid point. And I'm going to talk a little bit about that, buying in pieces and getting a big position later. But ideally, you buy the wedge pop here and you really size up here and raise your stop. And I'll kind of talk about that later.
Perfect. I think that's most of the questions for this one, so I think we can move on.
Okay. So next is just a bull pennant. I mean, this is basically a bull flag. The slight difference is you actually have higher lows and lower highs. So it's more or less the same thing. So it's a short-term pattern of lower highs and higher lows, similar to a bull flag. It just marks a contraction in volatility. It's best if you have heavy volume and then light volume as the pennant builds. And then when it breaks out, it triggers. So this is just an example here. This is from Teladoc, where we actually broke out of this little kind of mini channel, again, right off the 50 and 200. This is kind of a wedge pop through here, or you could even almost interpret it as a crossback. But either way, we're pushing out of this pattern. You can see the volume is nice on this follow through day. So ideally you catch this down here, but if you didn't, one thing we can do is, this is the change of character, right? If you really go look up this example, this is a huge monthly base, multiple shakeouts on the lows, which I'll talk about that later. I'm actually going to show this example later. And we see the change in character, like we've broken out, right? Let's say you miss it. That's okay. We get a little bull pennant here. I think this is about a 5 to 7 day pattern right into the 10-day. And then when we push out of this, that can be another opportunity to get on this thing. And literally in 1, 2, 3, like 4 days, you get a 30% move in this thing in 4 or 5 days. So this is an example of a bull pennant, very similar to a bull flag. So I won't say too much more than that. But it's another, short-term continuation pattern that you can utilize to get onto stocks. Okay. Okay, so now the breakaway gap, or you'll hear people call it a BGU, the Bible gap up. This is literally what it sounds. It's an explosive gap out of a basing pattern. In my opinion, like buying gap ups out of short-term patterns is not the best idea. They can often fail. So you really, really want to have a nice base that you're breaking out of when you're playing this pattern. And for me, it just about always occurs with a catalyst, earnings, product announcement, FDA approval. You'll see in my trading, the majority of this time, it's an earnings gap up out of a large basic pattern. So earnings for me is the main thing that I'm looking for, which is why kind of when you're coming into earnings season and you're checking your dates, if you can find big weekly basing patterns that you want to pay attention to in particular, those are generally the best candidates for the Bible gap up. So again, you can see I really like this book, Trade Like a Neo Disciple. They talk about this extensively. I think it's probably one of the major patterns that they really pay attention to. And a lot of people ask me on Twitter, how do you get into this? It's really difficult to buy these gap ups. And my response would be like, yeah, you're right. Like they're not the easiest patterns to buy. So I would say, you might screw it up sometime. You're not always going to get it right. But the key is, most earnings are in the afternoon in the post market. You want to see volume coming into that stock in the post market. Oftentimes you'll see 40, 50%, sometimes even like a full average day's volume take place in the post market. So you want to be tracking that run rate because heavy volume is going to greatly increase the chances of this working. So a good way to approach it is to buy in pieces. So you could buy a little in the post market, maybe a little in the pre-market, and then kind of look to top that position off in the general session. Or you can just wait, and actually this is probably the safest way to treat this, is you can just wait for a lower time frame entry, the next day in the regular session. The risk of that is some of the best ones will really fly in the post market, if the earnings are really exceptional. So unfortunately, there's no best way to do this. This can be a difficult pattern to trade, but it can also be very, very rewarding. And sometimes in my experience, the absolute best ones will just explode right on the open, after the report. So if you're really good at analyzing earnings and, determining when the earnings are exceptional, you're going to have a major edge. I would say that that's not actually my skill set. I'm better at just, going for it when I get a feeling that the stock's right. So breakaway gap, I think the key is make sure there's a base, make sure there's volume. Sometimes real thin stocks will not trade much in the post market. I would avoid kind of executing those real thin names, just because, maybe they get marked up and sold right away when the market opens. Just wait for the general session on those. But this can be a powerful pattern that when this works, it often leads to multi-week moves. So that's really why it's worth paying attention to.
And once again, with this pattern, it's really important to keep everything in context, right? Because ideally, you want to be focused on that first gap up from a long-term consolidation versus when the stock's already pretty extended and has had 2 or 3 gap ups like this.
Exactly. Once a stock's extended, they may gap it up so that they can drop all their shares on the market. That's very, very, very common for a stock to actually have an exhaustion gap at the end of the move. So, for example, let's just look at UPST here. So this was a big consolidation, and we gapped up. And in this instance, you could have played day one, but a pattern I really like is when you buy through the highs of day one. So that's another thing, is buying through the highs of day one, and then it goes on a move. But let's just say, for example, forget the stock, and let's just say earnings are right here, and the stock gaps up to like 375. Like, to me, that's a risky buy, because they may gap it up, you may buy, and then they sell it down to 300 by the end of the session. So want to be buying coming out of that base, don't want to be buying when it's extended out of that base, if that makes sense.
For sure. And there were some questions about kind of your comment on thin stocks. Could you kind of talk about what you look for there in both the regular session? I think it's also different in post market as well, right?
Sure. So don't overcomplicate it. Just literally, if it's not trading a lot of volume or any volume at all in the post market, you probably don't want to be getting involved. If the spreads are really, really, really wide, it's just not trading a lot of volume. It's not liquid. You're better off just waiting. Now, as far as once the regular session starts, if you have a stock that, on a 5-minute bar is moving or let me not say $1, let's say 2% on one bar, that's not a very liquid stock. You can still trade that if you really, really like it. I personally like more liquid type stuff, but just take into account the volatility in your position sizing, because you're naturally going to be taking more risk. So for example, Bros, I know a lot of people on this are probably watching the Bros earnings report. That's a stock that doesn't trade very liquid. So, you kind of have to take that into account in your position sizing, in that it's a $60 stock that'll move $2 in a 5-minute bar. So you either one, want a position size down, or two, you want to really make sure that you're kind of piecing into that thing, and make sure that it's giving you positive feedback before just kind of going all in on it. So that's kind of what I would say as far as liquidity.
Perfect. And there was a comment here from Steven that I think is a good thing to point out. In the breakaway gap cases, you're most likely buying when a stock is far from the 10-day, because it's a breakaway gap. So it doesn't matter in this case, right? It's more for the bull flags.
Yes, exactly. So in this instance, you're naturally buying away from the 10-day. Now, the base initially is probably near the 10-day, but just because the gap up is so big, and really, the bigger the gap, the better, actually. you're naturally buying extended from the 10-day. Yes.
Perfect. I think there's a similar question to follow up here. Would you let's see. Can we still trade the gap up even if we are far away from the principal base, but we are not extended? Um, I guess you kind of answered that. Like, yes, you want the gap up to be large and breaking out of the base if possible into new highs.
Yeah, exactly. Exactly. I am not going to be looking to buy a gap up off a stock that's rallied for like 4 to 6 weeks. But if it's breaking out of the base, even if it's like, short term extended, that just a product of it having a big gap, that's something that you can trade.
Perfect. I think we can move on to the next one.
Yeah. So this is something that I actually prefer more than the straight up gap and go. Is what I'll call the post earning per share flag or mini base, whatever you want to call it. And it's when a stock gaps out of a base. So if you go look at the Asan monthly, this was the first move out of its IPO base. It had a big level at like 36, $37. It gapped up on earnings on big volume. And then it actually pulled back for a day into the 10-day. And it kind of built this little bull flag and then it went. So it's not uncommon for me to buy day one, get stopped out, and then re-engage on this pattern. And I love this pattern because it's just easier, right? You're not, kind of buying that gap up. You're better able to manage your risk into the moving averages, and it's kind of letting you know, hey, gapped up, earnings were good. Okay, we're going to let it, the institutions are going to let it consolidate for a day or two, and then they're going to step in and start buying. This might actually literally be my favorite pattern to trade. I think one that we're seeing right now, hopefully, is in SoFi Financial, SOFI. But this was a great example in Asana. So go back and look at this monthly, go back and look at this weekly. It was a stage one IPO base, and it was past the 6-month lockup period. So I love trading IPOs that are past the lockup. I've seen studies that show most stocks do not make their move until after that 6-month lockup period. There's certainly exceptions to that. GLBE this year, obviously Google's the one everybody knows about, but generally speaking, stocks will get past that lockup and then they'll move higher. So we get this gap up, little pullback, let the moving average catch up. This starts to look like a bull flag. You could even start buying this into the moving averages and be adding through this breakout, and then maybe even add a little more through the pivot high here. But that's nice because you kind of buy in 2 or 3 spots. Let's say you get a little here, you buy through here, bring your stop up here, you buy a little here, maybe bring your stop up to like in this range, and then when it really pushes out, you can raise your stop again. And now hopefully you have a big position, breaking out of a big base with an earnings catalyst, and you've been able to piece into it and kind of manage your principal risk. That's why I love this pattern, is it allows you to kind of get a big position, piece into it, and then, kind of manage your principal risk pretty quickly.
And are Roblox and Airbnb 2 more recent examples of this type of basically setup?
Yeah, exactly. And I'll tell you what, how about kind of when we go through the slides, we'll look at some of those recent ones, because there were a bunch of these this past week.
Perfect. Let's see if there's any specific questions. Do you look for a volume dry up in this case on that pullback?
Yeah, it's good to see that. So big volume, and this one we saw big volume, but then we do kind of see the dry up here, and then we push out. I do think you want to see big volume on day one, though. And I think a big misconception is, people will say, hey, we saw huge volume and then it pulled back on lighter volume. Isn't that a red flag? And I sort of view it like, well, if you don't see big volume on day one, like nobody was interested. And then, so people say that it got sold on day one and then it's like pulling back on lighter volume. No, I view it like if it's right here, it's breaking out of this base on volume, and then it just kind of needs a day to rest, and then the institutions step back in on it. And one thing I would say on this pattern, because like I said, I'll often really like some of these are the patterns I like the most, and I'll buy day one. I'll be aggressive and I'll get stopped out and I'm all pissed off. But I don't get deterred. I come back into it and I'll buy the bull flag, and oftentimes I'll buy a significantly larger pattern or position the second time around, because I view it like they supported it and it's just showing me, hey, they want this thing. So if you get stopped out on day one, don't be afraid to come back into it and on this pattern, because I actually think this is a better pattern, at least for me.
And people are asking within this type of setup, where are you looking to make your buys? Is it as it breaks out of that flag, or is it as it's trying to approach that flag? Maybe you're going down to an intraday chart, an hourly, to try and manage risk, get in and anticipate a little bit before the fall through.
Yeah, so kind of similar to the BGU, I like to do it in pieces. So I may buy kind of like a pullback area into the EMAs, or sometimes with this, it's like it's not always going to touch the EMA exactly. So you kind of have to use your discretion as to where you want to get involved. And then I'll try to get a little more and get a little more. So it's almost like I like to kind of get involved, and then I like to really kind of size up more when the actual bull flag builds, because then I feel like I have a more refined stop. Whereas let's say I put a little on here, it might go a little lower, but I'll have a small position. But then as it pushes out here, I feel like, okay, our pivot point's been created. I can put more size on and put my stop here. And then maybe I top it off through here. And when it pushes, I raise that stop more. So I like to buy these patterns in like 2 or 3 pieces. And I think one of the things that's not talked about a lot when it comes to risk management is just buying in pieces and the size of your position. So many people say, "Oh, I'm risking 1 or 3% or whatever." It's like, okay, well, if you risk 1% on a 30% position, that's the same risk as 3% on a 10% position. So maybe you start smaller, and then you kind of work into it as it gives you positive feedback. And as your position gets bigger, then you're going to need to tighten up that stop so that you can better manage the risk that you've got on the table. And another thing is too, is if you have high conviction on a stock, maybe you thought the earnings were really, 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 really great. Maybe let's say your end target goal is like a 30% position versus maybe another one you have less conviction, it's a 15% position. You should take into account the overall risk you're willing to give that stock based on what your end position size is going to be. Does that make sense, Richard?
100%. And
Okay.
does it matter for you the closing range of that first gap up day? Like, do you prefer it to be in the upper half versus the lower half? Does that matter at all to you?
Well, so look, like some of the best ones are just going to go right on the open, right? Like your
Yeah.
true BGU, they just rip right on the open. But in this instance, like it doesn't go on day one. So to me, it doesn't matter quite as much. It's more kind of how it trades the next 2 or 3 days. Like if on day two it just rolls here, like I'm not interested in that. Like I
Right.
definitely don't want something that's closing on the low of the day. But if it's kind of mid range here, that's okay. And then day two, we want to see it get supported. Day three, we want to see it get supported. We don't want anything that's closing on the real low of the day, in my opinion, because that's usually a sign that the institutions are probably selling that report.
Perfect. All right. I don't see any more questions about the. Oh, actually, there was one that was a good one. Do you kind of substitute any other shorter term moving averages to the 10? Usually use the 10 and 20 EMA, but for these, obviously, those are going to be pretty far below price. So do you use any short term moving averages than those in the case of a gap up?
Yeah. So one thing that I've started adding to my charts, I don't have it here, but it's the 5 day moving average. Um, And this is something that I've learned. I've told you guys to follow Jeunesse Capital on Twitter. This other guy on Twitter who I think is probably an excellent trader, Tony Stark. He's told me to watch the 5 day because it really kind of shows you the character of the stock. I'm not necessarily really buying off the 5 day per se. Um, I think it's something I'm experimenting more with, and I'm still learning how to use it.
Right.
But I think it can kind of show you the character, like, where is this thing being supported? If the 5 day starts to show support for, maybe a day or two, and it builds a pattern, maybe you start to play that pattern. Um, I have bought stocks off the 5 day, and it's what I've found is that they're just not quite ready to actually follow through yet until maybe the 10 day catches up. So maybe it finds support on the 5 day, but then it will base for a couple days. Whereas I think with the 10 day, it may be ready to kind of go, within a day or two, or 3 days. But it's something that I'm personally still learning about and experimenting with. But I think the 5 days of moving average you can put on your charts, more to see that character.
Perfect.
Okay. All right. So next would be the descending channel. I actually think this is, outside of that kind of post earnings per share flag, I think this might be my favorite pattern. So this is a multi-week pattern of lower highs and lower lows on the daily chart. It'll look like a bull flag on the weekly chart, right? So think about a 3 to 4 5 bar pattern on the weekly is a bull flag, but then on the daily, it's a descending channel. So if you just wanted to look for bull flags on the weekly, you're likely identifying descending channels on the daily. And then this is key, near the end of the pattern, you'll really start to see the price action tighten. And at some point, you'll see some sort of higher low, or at least it'll hold a previous bar's low. And it's really a sign like, hey, buyers are saying, okay, we've corrected enough. Like, we're going to stop that trend of lower lows. And it's just that change of character. And then you want to look for that trigger. So this just about always lines up with a wedge pop, which makes sense, right? Because we've had a multi-week pullback. The 10-20 EMA are usually kind of right over price. And then when we pop back through it, it triggers the wedge pop. And oftentimes this will have kind of 6 points to it. So if we look at this descending channel on NVIDIA, there's 0.1, 0.2, 0.3, 0.4, 0.5, 0.6, and then it'll go. That's not, always how it's going to be, but I find that to be pretty accurate. I think I'm not positive about this, but I think in John Murphy's book on technical analysis, he actually points that out too. But the key is this is tight and uniform. Like, we don't want like crazy loose descending channels that are just wild. They may work, but the better ones are going to be real nice and tight. You can see in this one, we have the wedge drop here, but it's tight, right? And it's being shaped right under these moving averages. We come down into the 50, 200 SMA area. So we're coming into those longer term moving averages. And then we start to see a change of character here. And then we have another lower low here. And then what do we have here? They gap it down and they do what's called a bullish counterattack bar, or an outside reversal. And I'll go over this later. But buyers step in and they support this stock higher than the previous low, right? And then for me, the pivot on this and the wedge pop is right here. And when we break through that, that's the trigger. So we're clearing this descending trend line of the descending channel. We're triggering the wedge pop pivot, and we're coming back up through the moving averages. So that's the real buy area. And then I think what a lot of traditional people would highlight is this pattern here, this bull flag. So a lot of people are getting on this stock here. You may be able to add to your position here. And then a couple other things that just highlight, why this is likely going to go on a big move. We have the gap up here that remains unfilled, a sign of strength. And then something I love to see near the beginning of this pattern in particular, because we're kind of coming more off, I don't want to call it off the lows, because, we are still near the highs here. We're just kind of pulling back as the market's correcting, is we get these 3 little unfilled gaps. And you'll often see this on some of the most powerful descending channel breakouts, where it's like, the institutions, buyers, they're chasing it up every day because they just can't get enough stock. And those little unfilled gaps are definitely a sign of strength. So this is a great pattern, because when it works, you're coming out of a nice non-extended area near the 50, in this case the 200 SMA, but you're not always near the 200 SMA, and it can often lead to fairly extended moves higher.
And this might be another example where you kind of build into your position. Is that right? First on that outside reversal, bullish counterattack, and then adding through that wedge pop pivot. Is that right?
So you could, and
Yeah.
is what I would say is like a very, very aggressive trader may notice this price action intraday and start buying and then add here. I can just tell you, I did take this trade, and I actually, saw this as still weak, resistant at the moving average, and expected us to roll over. And when we gapped down, I was more surprised that it got bought up, and I played the wedge pop just up here. But this surprise right here, this bullish counterattack showed me that buyers were stepping up and supporting that higher low, which gave me conviction to be aggressive on this gap up. So look, if you're a really, really good trader, like literally I trade with some guys who I think like bought the low here just because they're unreal. Whereas I wasn't that guy. I bought through the pivot here, but I think it's valid if you really want to see this close on the highs here, in my opinion, if you're going to get involved, because we're below the moving averages, and it's still a little suspicious to me until we take out that pivot. So it just depends how aggressive you are as a trader as to where you start to get involved. And in this
Perfect.
instance, versus like the post earning per share bull flag and such, I am usually trying to get the majority of my position on, right away. Maybe I'm buying a little on the gap up and then topping it off at the end of the day, but I'm trying to buy my position as close to this pivot as possible, because you start buying up here and such. How do you manage your risk? So I am trying to get the majority of my position on day one.
Perfect. And you might even continue to build out your position on that bull flag that we've got there just a few days later.
Yeah, so in this instance, Nvidia actually reported earnings and it traded down on earnings here,
Right.
which was kind of funky. It like didn't do anything. It didn't really go down or up. But then when we took this out, I did add to this. And the reason you can add here is because you have a new pattern and then you can raise your stop. So that's vital.
Perfect. Let me see if there's any questions. Yeah, so there was one that was interesting. So on this descending channel, is there a specific percentage that you would like to see it pull back, or do you want to see it stay above the previous swing high within the base? Is there stuff like that kind of you take into account? And yeah, how do you kind of view those questions?
So I am more judging the tightness of the pattern relative to the index, right? So in this instance, the Nasdaq's pulling back, and that's like honestly, Nvidia wanted to go higher right here.
Mm-hmm.
It wanted to turn and go, but the market pulled it back. So I'm more judging the tightness, and then yes, I am judging it relative to a previous base. Like I don't want this to lose, previous pivot low in a base. However, if it's tight, it's very unlikely going to be doing that. It's only really going to be doing that if you start to see massive distribution come into it. So I'm more looking just for tight action, and I'm judging it on a relative strength basis relative to the sell-off in the index.
Perfect.
Or even just other growth stocks in general. Because I mostly trade growth stocks. So if I see a lot of growth stocks selling off and I can kind of find the one that's trading real tight, to me, that's another way to judge relative strength.
Perfect. Yeah, I think we can move on to the next setup.
Okay. And so the descending wedge, this to me is, kind of similar, like the bull pennant to the bull flag, the descending wedge versus the descending channel. Very, very similar patterns. The real difference is that the pattern kind of converges more. So you have lower highs and you have lower lows too, but the lower lows become like less pronounced to the downside. Is what I say here is, similar to the descending channel, but price tightens as the lower lows become less and less pronounced. And to me, this is a sign sellers are becoming less aggressive as the length of the pullback continues. So this is key when you're looking at a descending channel, is to look for price that makes a new low, and then reverses higher, showing that buyers are starting to kind of overpower sellers. And you'll see here in this example in DigitalOcean, we sell off and we kind of come up, and you can see they gap it up and sell it, so it's not ready yet. But we then see a support bar here, and it's just not quite ready yet. It rolls over again, and then what do we see? So right here, we took out this low and we rallied up and closed the day above it, right? So that's kind of point one where we're seeing, buyers kind of show aggressiveness, if you will. And then right here, we take out this low, and what do they do again? They take out the low and they close it back above that previous low again. So to me, it's like this stock, every time it makes a new low, buyers come in and they support it. Now, they're not quite ready to take it higher yet, but they're showing that on the lows, they're accumulating stock. And that's what I'm looking for in these descending wedges is I want to see when price gets on the lows that sellers aren't able to, overpower the buyers. And I call that, no sellers down low, or the stock's getting sold out. Or, something I say is just, it's being stubborn to the downside. The market's selling and it's pulling this thing back, but every time it looks like it's really going to come apart, buyers kind of support it. And they're just not selling it down. And then what happens, at some point we kind of create a pivot here, right here in this instance. And this is generally always a wedge pop as well. And we pop through here. And the nice thing in this instance is you get another pivot quickly where you can pyramid. And, that's the best case scenario to really have a big winner is when you can pyramid quickly right away. So basically when you see this kind of, I call it scumming. So it scums to the downside. It scums this low. It scums this low. When you see, maybe two scums, you may start getting ready to kind of look for a pivot to build where you can look for that breakout higher. And that's the descending wedge.
And here as well, we've also got the confluence of the 50-day simple moving average coming up. So yeah, always looking for that confluence for sure in your setups.
Exactly.
And yeah, just to re-emphasize the point, you've told me previously that you love it when you have a little bit of a breakout, then it goes quiet and tight again. You get a re-breakout, quiet and tight, and that's when you can really size up your position and put on some size. Yeah.
Yeah, so like I'm gonna kind of talk about this later, but we'll touch on it here because it's a pretty good example. Like, let's say that you buy this breakout here, and it kind of goes up and it pulls back, it kind of tests your buy point, and you're kind of like, oh man, like is this gonna work? But then it sets up and it takes out here again. You can actually add to your position, and this is almost like better than if the stock just rips higher, because think about it, you can buy some here, and then it sets again, and you can buy more. But you're moving your stop up. So your initial shares are like riskless. And now you're taking the risk you had on your initial shares on your second set. And you're able to get twice the position with like the same amount of risk. So then if the trade works, like you've got double the size.
Right.
And so for me, I can get kind of, stopped out over and over and, just not making any progress, or maybe I hit a winner with regular size. But then when I can get, maybe 2 or 3 of these trades in a row where I can get like double my position without taking more principal risk, like you hit 2 or 3 of those in a row and like you can literally just dramatically change the performance of your account in like 1 month, where you get, 2 or 3 big positions on without a ton of risk because of the way you were able to buy the stock.
Right. And yeah, I think that's a golden nugget. I put that in the chat. Definitely rewatch that part going through it. But there were some questions, Oliver, about buying through a pivot and whether volume is at play right when you're trying to execute a trade. What are you looking for in terms of relative volume, that type of thing?
Sure. So on something like the buyable gap up, like I'm definitely looking at relative volume, because like literally volume is an absolute requirement for the trade. Now I'm not always like actually looking at the volume when I'm buying these, because sometimes I'm buying, before the traditional breakouts. Like, where's the traditional breakout here where volume kind of comes in? It's like more up here.
Mm-hmm.
But sometimes off the lows, you're not always going to see huge volume. Now, if you do see huge volume, it's like a definitely a positive indicator. Like you start seeing big volume, that means institutions are being more aggressive, and it's a major, major, major positive sign. So if you do see volume, you want to probably be more aggressive in buying shares aggressively yourself, but you're not always going to see it. So I will take a trade without volume, but the one thing I would say is I am but there's like multiple weeks of study that go into me buying this little pivot, right? Some people will just go through patterns and say, oh, look at this wedge. I probably started watching the stock like in here, like look at this volume on the up move, volume, and then we're watching these scums here. We're watching supportive volume action right here, the volume on the up move here, and then dry up on these down moves. Like I'm like building conviction by watching the volume patterns all through this basing pattern. And then, maybe like we don't see huge volume here, but guess what? We see a slight uptick here, and then we see tight action. So the volume patterns in this whole base here are positive.
Right.
So it's not always on the breakout day. It's like in the weeks that lead up to it in the formation of the pattern, because these institutions are the people that are building this wedge. They're the ones that are driving price back higher when it tries to make a new low. They're the ones stepping in and creating these positive volume patterns. So one thing I would urge people is don't just like go through the market and look for patterns and look for volume on the breakout. Study the volume inside the pattern, because that's the real edge. Study the volume inside the pattern.
You're looking for evidence that institutions are in there accumulating and building positions.
Exactly. Exactly.
Perfect. Yeah, I think we can move on to the next pattern, I believe.
Okay. So those are kind of the more, I guess less IBD traditional patterns or whatever you want to call them. Now I'm going to go through, some of the patterns you'll see IBD people or canceling people focus on. The flat base. I personally don't really follow the exact IBD rules. I just look for a consolidation. Like, sometimes these will be multiple years long, sometimes they'll be multiple months. I think for an IBD flat base, it's considered a continuation pattern, usually in the 5 to 8 week length range, following a previous advance. But for me, I'm looking for a huge consolidation. Sometimes an initial base, like I said, will be multiple months or years in length. And mostly I'm focused on this, the bigger the base, the higher in space. And it's the idea that when you have a huge, huge, huge base, when it breaks out, you're going to get a larger move. So I don't get so caught up on, the length and all that. I'm more just like studying how it builds. And then often, like I said earlier, you'll see some tightening action, flaggish type pattern or something along those lines, near the upside. So, we get a big base, we come up here, and maybe you get a shorter term consolidation right here before it busts out. That's what I'm looking for, because that's where I can manage my risk. And this is a big pattern a lot of the times. And you want to see volume come into the stock when you break out through this level. But similarly, we want to be judging the volume patterns as this whole base builds. So here below, this is Silvergate. This is, traditional flat base. We'd had an extended move, and then we based for about 4 or 5 weeks. Couple things here. Look at the decline in volume through this base. And then in this instance, we actually had a secondary on earnings. And you can see that they bought up all the shares of the secondary. So notice the shakeout here, and that there's a level here, and they kind of sell it down here and buy it up, and then they shake that level and close it above it on volume, showing that institutions supported that secondary. Then we clear this descending trend line on big volume. I think that could be your first entry. And then technically the flat base breakouts right here when we take out the high. But I think a savvy buyer would probably be stepping in here. And then let's say you miss this initial breakout. What do we get? We get a little bull flag right here. So this is like the wedge pop. This is the cross back in the form of a bull flag. And I think this is kind of your, another area where you could really get involved, or if you bought here, you could pyramid into your position. And then from there, I mean, we literally get a double in like 2 or 3 weeks. Pretty amazing, actually. So this is an example of a, flat base. And this is a pattern that I like to trade as well.
And that day where we had that secondary in earnings as well, it undercut basically the entire price action of the flat base. Is that something you look for, a shakeout before a then move up and an attempted breakout?
I think patterns are better when you get shakeouts because it gets rid of the weak holders.
Right.
And then the people who, think about it, this shook out. It's a reason it shook out. Somebody sold, right? If I was in this, probably me. But then the big players, the T Rose, the Fidelity, they bought it up and they closed it above that shakeout level, showing there's demand for this stock. And then when you follow through, it's a sign, hey, they didn't get all the stock they needed down here. They kept buying through here. So yes, shakeouts are huge. It makes a pattern just that much more powerful when it does actually trigger to the upside. So I think if you see shakeouts that close above the shakeout level, it's a sign of institutional demand.
And that up of the offering, that was a huge clue that there was a lot of demand for the stock. And
Exactly.
that's why it's always important to kind of watch the price reaction to big news events or events like that versus just the actual news itself. It'll give you more insight into what the institutions are doing on that particular day.
Exactly. So like think about it. We had an earnings catalyst and then we had a secondary, right? And that secondary gets soaked up. Um, that's a sign there's demand, like big time. So that's a form of using a catalyst within the pattern to help give you conviction.
Uh, I think I think I think that's all the questions for this pattern. So I think we can move on.
Okay. So then the cup and handle. I mean,
Oh,
very.
Oliver,
Oh yeah.
did you want to take a break at this point before we get into the traditional patterns, or are you good to keep on going for a little bit?
I'm good to keep going. You kind of let me know how everybody's doing.
I haven't seen anybody begging for a break yet, so I think we're good to keep going for now. But we'll
Okay.
take a break shortly after in just a few slides, I believe.
Okay. So the cup and handle. Um, Really, it's a cup with a handle. The handle should show tightening price action. Um, I think if you use my price cycle, you can often get in before the handle. So you'll see that I say, the bottom of the cup down here is usually the wedge pop. Then you'll have an EMA crossback, which we see here. And then that handle is usually in the form of a basin break, which is exactly what we see here. So the one thing I'll say about the cup and handle, or really any base for that matter, is the depth of the cup is, you have to take it in context of what the market's doing. So this is an example of trade desk coming off the COVID lows. And, this is like a 50% deep cup, which technically is a violation of kind of that 30% deep base. But, we had a 35% sell off in the indexes. Now, if we had had a 10% sell off in the indexes and I saw a 50% deep base, I would be thinking this is likely a punch bowl of death and it's going to roll back over. So that's about taking the index into account and how the base builds. And that's kind of how you have to judge your cup and handle. So it is what it is. It's a cup, it's a handle, and the buy point is through the top of the handle. Notice in this instance, we see that shakeout here on the right side of the handle. Another example of just, we love to see shakeouts kind of before these patterns trigger because it shakeouts those weak holders and it shows you that when we close back up, institutions were actually buying. And then when we trigger through here, it's a positive side. So that's really the cup and handle. It's exactly as it sounds. Then next, I would say is the double bottom base. So this is a consolidation again with a shakeout on the lows. So I personally call this shakeout a 2B reversal. It's a term that market wizard Victor Sperandeo, I read about in his books. Highly recommend both his books that I've read, Trader Vic, VIC 1 and 2. Definitely read those. You can actually learn a lot about trading events and policy and stuff too. But I call this a 2B reversal, where we basically come down, we make a low, we come back up, and we take out this low, and then buyers step in. And for me, usually when buyers step in, it's in the form of a wedge pop, which you can play the wedge pop, or you can look for that kind of cross back or some sort of consolidation at this point to go higher. Now, the true can slim buy point is the midpoint of the double bottom base. I often find that, for me at least, the market is already kind of extended by the time we get there. So I'm usually buying a little bit in advance of it. But if you think about this pattern, we come down, buyers support the stock, and then this is really representative of a stop run, in my opinion, where we shake out this low. The market just wasn't quite ready to go higher. We run those stops. Another sign that institutions are supporting it when they bring it back up. And then we look, for that shorter term, flag, pennant, or crossback of sorts to get involved in the stock. So here's an example in Roblox from when it was, a younger IPO. We came down. We actually technically had a little wedge pop here, but then it failed and we had a wedge drop. We take out this low, and then we get a major bullish engulfing bar on huge volume. Now, for me, unless you're very quick, you're probably unlikely to catch this. I didn't catch it. But this is a wedge pop. And then we get like a flaggish type look here. Again, we see more volume. So the volume pattern's very good. And then right here, what do we see? Another clue of bullish counterattack bar. So that's another clue. And then when we take out this pivot here, we explode on a little mini gap, and you get a 30% move in 7 or 8 sessions. So that's an example of a double bottom base. I think if you were to go look up the specific IBD type rules, it's probably more of like a 5-week base or something. I'm not sure. But I'm more looking at just the structure and kind of how it builds, and if I can get a low risk tight entry on it. Now, this one does build right at the pivot here. But sometimes you'll see that, build a little lower than the pivot, because usually this pattern's actually a little longer and deeper than this one. But you have to use your discretion as how you analyze these things, and they're not always going to look the exact same.
Do you handle this type of pattern differently depending on the prior run of the stock? Like Roblox obviously was a recent IPO, but do you usually like to see a prior advance before this type of pattern? Or, yeah, I guess that's kind of my question.
Yeah. So, I mean, it's always good to see an advance in any stock you're buying, really, kind of before you get involved in it. Because, most stocks that are going to be big winners, they move and they base and then they move again. The one thing I'll say that this specific instance is usually when I'm trading an IPO prior to the lockup period, I'm treating it as more of a flip versus when it's after the lockup period. It can be more of a, bigger position trade. And I think, one of the themes this year, probably around the middle of the year, is a lot of these IPOs had a lot of opportunity, but they had these, quick moves and then they rolled over. And to me, it's because they were prior to the lockup period. Basically, I think you want to be, more in quick swing trade mode than after the lockup period, when the institutions have had a chance to really do their work. Then you can look for more of a hold. Again, that's not going to hold perfectly. Like, I don't want you to miss the next Google because I said that. But generally speaking, I think that holds true more often than not.
For sure. And let's see. Um, On roadblocks, how would you manage your stop? Obviously, this is a young IPO, and the ranges are a little bit more volatile than a more mature stock. So, kind of how would you handle that?
Sure. So I can just tell you the way I traded this one is I had seen this volume, and this was to me the change of character. Like
Right.
when I saw this huge range, like, I mean, this thing was up like 15-20% in one day. I don't even remember. I'm sure there was news or something. It doesn't really matter to me. But this was the change in character because we saw big, big, big volume. And then it got supported when it pulled back, right? So that's kind of a higher low. And you could have tried to play this flag almost. I didn't. But then when we saw this bullish counterattack, I felt like this was kind of getting ready. And I actually bought initially the pullback into these EMAs. And then I added on the pivot breakout. But I think the real buy area is through this pivot breakout. And once it breaks out, your stop is right here at this low. So the way I traded is I bought some here and I added here. And when I added, I had my stop here. Once it moves through the pivot here, you don't want it to come back down through the pivot. So that's kind of my idea from the beginning of the pivotal point. Like, hey, we've determined when price moves through here, it should go. So if it goes up and comes back down through, I'm not really the kind of guy that wants to hang around. Now that can shake me out of positions for sure. But to me, especially since there's volume here, once it kind of goes through the pivot, the volume's there, you want to have your stop at the pivot breakout day's low. And then kind of once you see follow through here above this next day's high, to me, I'm kind of keeping my stop sort of right in this range, making sure I don't have a loser. That's how I'm treating it.
Perfect. I think we can move on to the next setup.
Sure. Okay. So the wick play. So I think a lot of people have kind of, you know, misinterpreted what the wick play is. So if I could say like what my favorite patterns are to trade, I would say one, it's like the post earnings per share flag, or just, that flaggish type look within a bigger base. Two would be the descending channel or wedge. I kind of treat them like they're the same pattern almost. But three would be the wick play. And the wick play is very rare. It's not a pattern that happens very often. But when it happens, I am like all hands on deck, because I think that it often leads to a multi-week move. And it usually just goes when it goes. Like it's not gonna squat or anything like that. So let me explain what the wick play is. So with the wick play, you'll have a price bar with an upside wick. So I'll use this UPST in August of 21 to explain it. So right here, we trade up and we trade back down, leaving a wick, right? Then the next price bar trades the entire session inside the previous day's wick. This is also an inside bar, and it's even better if there's volume dry up. So if we look at this bar, it's entirely inside this wick. And I made a mistake. I cut off the volume, but there's extreme volume dry up here on this bar. Go study this pattern, print this out, look at it. So the trigger is technically when we take out this wick high right here, the initial sell down wick. But because this is an inside bar, it's often going to move when we take out the high of this bar here. So the trigger is through here. And in this instance, you'll notice we even have a tiny little unfilled gap. But this goes and it goes, and this stock rallies for, multiple weeks. So if you missed that BGU around 190 or so, I think I cut this off, but I think this was around 210 or 215. This was kind of the next area to get involved. And I absolutely love this pattern. I think it's awesome. You only see it a couple times a year. And when you get it, you usually get a big move. And so let me kind of go through why I think it's a great pattern, the psychology behind this pattern. So if you think about it, sellers sold down the stock to create the wick. And it shows like, sellers rejected buyers. They're in control, right? But then buyers support the stock inside on the wick. So to me, this is kind of that like, all right, like we're going to step up and support it, but the sellers kind of aren't quite ready to let it go. So we're kind of in a stalemate right here, right? We don't know what's going to happen. But the fact, that you get volume dry up and it's inside bar, the table is set for if this thing triggers, it can really move. So then when the highs of the wick are taken out, it's a sign that sellers were in control, stalemate, buyers take control. And that's why it's a great pattern, because it's literally like in a little micro set of 1 to 3 days or 2 to 3 days, you get to see sellers, stalemate, buyers, and boom, you start to get that move higher. So very, very key pattern. If you see it, pay attention to it. I almost think when you see it, you watch nothing else that day except that idea, because when it works, it really, really works. Here's two other examples very recently of NVIDIA. You can see, we had a move higher, and then, this is like a little flag or whatever. And, it's often in the form of a flag. Wick, trade inside the wick, take this out, and it blasts higher. This thing really, really blasted higher. And similarly with Tesla, this is actually the wick play right here. So this doesn't even like look that great, and then it closes down here, but it's inside this wick. And then when we take out this high, like it doesn't explode, but like it really, really gets going when we get through the high of the wick here. So I'll even tell you, I will start buying sometimes on this day, and then I'll add on confirmation. The scenarios where I'm buying here is when I'm seeing that volume dry up. Very key for me. Volume dry up is very, 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 very important. And then when you can add on the confirmation. But I love this pattern. I think it's awesome. Any questions?
Yeah, people have a lot of questions about this one. So yeah, a lot of people are wondering whether you kind of anticipate and start buying on in that on the day of the wick play, which you already addressed. There's also a question about if the range on the prior day is super high, and obviously the wick is the space of the wick is quite large. Does that still kind of count as a wick play?
So, like, I mean, technically it does, but remember at the beginning where we talked about, does the risk justify the upside? If you have a ridiculously wide range wick, like that's volatility, and it's going to increase your risk, which begs the question, if I have to take such huge risk, is it worth taking? And, judge that for yourself. The best wick plays are going to be when there's less volatility. Like when there's tightening, volume dry up is usually accompanied by low volatility. So, the best wick plays don't have those extreme ridiculous wicks, because the best wick plays are just showing tight volatility, and it's just like a little mini battle between the buyers and sellers. Whereas extreme, you may get that huge wick after an extended move, and you get a wick play, and then often it'll like break to the downside actually, because usually you get volatility at extreme turning points. So I'm not usually playing the wick play when there's a massive wick.
Gotcha. And does the context of where this occurs relative to a base pivot or that type of thing, does the overall context of the chart pattern matter for these, or can this be a pretty short term consolidation and then you would still take that trade?
This can be like a short-term pattern in and of itself, but all these patterns you want to take in context. So if you go study all these examples, like for example, this happened after a BGU and we rallied up, and then it, based for a little. NVIDIA, we had actually a wedge pop around like 208 and 213. We then made a new high, and then it had this, and we really, really blasted. Tesla, we broke out of a 9-month base. and the real buyer was lower. But then this happened, and maybe this was an add-on area, or if you missed it, you kind of could get involved. And then all of these cases, this saw more of an extended move. I personally think the Nvidia move is still taking place. It has earnings this week, but you got a big blast right away, and in a couple days' time, you had a pretty significant percentage move.
And people wanted a little bit of clarification about the actual pivot point for this type of setup.
Yeah, so when you're trading an inside bar, the pivot is the breakout of that inside bar. So I think like that is the pivot. Technically, though, the pivot on the wick play is when you take out this wick. So I would say I look, if I really like it, like if I see this big volume drive, I'm buying a little here, and then I'm being aggressive through this first pivot. But technically, the way I was taught the pattern by this guy like 10 years ago is the true trigger is the takeout of this wick. But you know, I look at the inside bar wick myself.
Perfect. And people are pointing out that in your examples, all the initial wicks, that first bar that creates the wick, are red. Is this also the case for green wicks as well?
Yeah, I don't so much pay attention to the color of this wick. Actually, in all these cases, these are green, like the stock's up on the day. If you look versus the previous close.
Right.
Uh, but yeah, I don't pay so much attention to that. I'm more paying attention to it being in the wick, and I'm looking at the volume. Like I really want to see light volume. I think that's more important. Some of these will be green. This one's green, this one's red, uh, this one, or I guess this one's red. This one, yeah, I guess they're all red. You're right. Sorry, but it's more the volume and how the stock's acting versus so much whether it's green or red.
Right. And Robbie asked a good question, I think. Does the wick play kind of work the other way when it's basically a bearish pattern? Uh, yeah.
Yeah. If you have a down move and then like a little bear flag with a wick play that breaks down, I mean that thing could really fall apart. So all these patterns work both ways.
Perfect. Yeah, I think that covers most of the questions about this one. So I think we can move on for sure.
Okay. And then so kind of I feel like the wick play has been, misinterpreted or whatever. So I'm gonna just go over what I think people think the wick play is, and I'll call it, in the wick. Because I do think that this is useful. Like I think a lot of people thought the wick play was, if we just take out this wick high, that's a wick play. That's not a wick play. But I do think that this is like a helpful tool in managing risk, and I'll kind of tell you why. So if you think about the in the wick, I guess I've never really named this pattern, but sellers sold down the stock into the close of the previous session, right? So sellers sold down, and to me, we break out of this flag, and day traders probably played it. They took profits, and the stock sold off a little off the highs. That's probably why this happens. Then the stock gaps higher, and what happens? The first 10 or 15 minutes, they sell it down, they close the gap. But what happens? They hold the gap and they keep the stock from going red. And then when we take out that wick, it's a great area to manage your risk, and that you can manage it versus this gap filler, the low of the day, if you will. This definitely should always be treated as very supplemental, and a way to manage your risk versus the previous day's close. But I just wanted to go through in the wick. I think this is valid and kind of same deal, just based on the psychology of say some profit taking. They gap it up, they hold it green, and it triggers higher. You're likely going to see a move higher. I call this in the wick. But I see a lot of people who like there'll be a wick like this, like 5% from the 10-day, and they'll be buying it. I think that's pretty, low probability trade. It might work, but I think it's real important to focus on using this in particular as a way to manage your risk. If you want to add to a position, maybe you bought here and you want to try to get a little more on, so you use this in the wick type situation to add a little bit more. But you're really kind of using this bull flag, and this is just a sign that we're going to see continuation. So I just wanted to clarify, this technically is not the wick play. And, you know, I probably even just haven't described it well myself. But I do think that this is still valid to help you. But I don't think it's like got the same power as a standalone pattern like the wick play.
Perfect. I'm not seeing any specific questions about the in the wick setup, so I think we can move on.
Okay. So like these wick plays and things, they're all kind of, they're in the wick. They're kind of like little subtle tools I use. And so I'm going to go over a couple more of these. The outside reversal. This is a great way to buy pullbacks. So think about like a pullback into the 10 or 20 day, you know, maybe it's a 2 to 5 day pullback. And we want to find a way to kind of get on that stock, right? The outside reversal is the pattern to do that. So let's say we have an uptrend and we pull back 1, 2, let's say this is day 3 of the pullback. And then, you know, let's say we open up here and we trade down through the previous day's low and then back up through that low. You can buy through there with your stop on a low, or oftentimes they'll gap it down below this low and they'll trade it up through this low. So basically we want to see price trade down and then back up through the previous day's low in some way. There's multiple patterns, candlestick patterns. The bullish counterattack is technically an outside reversal, a bullish golfing, a bullish piercing. You know, I've seen other people take this pattern and rename it, you know, the oops reversal, the red dog reversal, whatever you want to call it. It's the outside reversal. If you read John Murphy's book on technical analysis, that's what it is. And it can be a great way to buy pullbacks. So you can see that this often aligns with support into the 10 or 20 period moving average. And it can be an early entry in a developing bull flag. So I'm going to go over a way that you can kind of piece into positions later using this pattern. But in this example, you can see Tesla kind of moved higher, pull back, and then what do? You can't really see it here, but they actually gap it below this day's low, trade it back up through, and that's kind of your trigger to get long this stock, and then it moves higher, and then actually right here is when you got that wick play, I believe, and then it moved even higher on that. So great way to get long on pullbacks, and it will often occur down into one of these shorter term moving averages. I actually think if it's not into one of the shorter term moving averages, you probably don't want to play it because this is a way to get onto an uptrend. The stock's trending, you're buying a pullback, and this is just a method to get onto that pullback.
Sorry. Perfect. And actually going back to the wick play, and there were some questions about whether it kind of applies the same psychology on a weekly time frame. So I'd love to hear your thoughts on that.
Absolutely. It's probably even better on the weekly because it's it's a bigger pattern. All of these patterns work on the weekly and the daily.
Perfect. Yeah, I think that's awesome. Yeah, I see some people are requesting a break soon, so we will do that soon. I think we just have a few more to go before we get into the next section.
Yeah, let's go through inside bars. This will be quick, then failures, and then let's take a break.
Perfect.
So inside bars, I mean, it's literally as it sounds. When the price bar trades inside the previous session's bars, this just represents a contraction in volatility. Extreme volume dry up is a very positive sign. So the lighter the volume on the inside bar, the better. And then when the highs or the lows of that inside bar are taken out, it can often lead to a move. So we have a bar, we then have an inside bar. If the highs are taken out, get long. If the lows are taken out, get short. I would say, you don't necessarily want to get short in an uptrend per se. But basically it's an inside bar and we want to play it on when we take it out. So I'll show you an example here in AMD. So we had the wedge pop here. We then pull back. This is a bull flag, and this is actually a wick play as well. So there's a wick play here, but it's an inside bar. And when we take it out, that's the trigger. And, you can see this led to a massive move here. But that's an inside bar. So love inside bars because it's just a way that you can really manage your risk, right? It shows contraction and volatility. It's best if it's inside of another pattern. So it's inside a bull flag, and it's also lining up wedge pop, EMA crossback, right? So EMA crossback, bull flag, inside bar, wick play. And when we take this out, we follow through on this level too, and it leads to a big move. So inside bars, definitely something you should absolutely be utilizing in your analysis of these patterns.
Perfect. Let's see. For if there's a case where there's multiple inside days in a row, what kind of pivot are you using to enter off that type of setup?
So it's usually the most recent one. Um, with that said, if the most recent one triggers, it should take out the previous ones too.
Yeah,
The previous ones usually aren't far off. Um, that's what I would say.
perfect. And in terms of volume, you ideally want to see a dry up in volume with that inside bar. Is that correct?
Absolutely. So look here at the volume dry up here on really these two bars, actually the volume dry up. And then when we trigger it, see the increase in volume. And then actually there's more volume on the follow through. So you definitely want to see volume dry up on all these inside bars, wick plays, whatever it is. Volume dry up precedes moves.
Perfect. And I do see some people wondering, yeah, all wick plays are a subset of inside bars. So they're kind of related. They're just the wick play is a more specific version of an inside bar.
Exactly. Yeah.
Um,
And actually right here, this is a great example of an outside reversal. Let me just show this real quick.
yeah, after earnings. Yeah.
Yeah. So we pull back, right? And right here, they gap it down. And then technically when we trade up through this level, I don't know the exact price, but it looks like about 120. You could get long there with your stop on the low. And I actually took this, exited before earnings, and then I got back in on this outside reversal. And then unfortunately, I sold too soon again. But this is an outside reversal, and this is probably a better example than that Tesla example.
And there were some questions actually about the outside reversal pivot. Is it back through the low of the prior day's candle? Is that right?
Yeah, exactly. So literally the pivot's down here. And then obviously, really this can be a precursor to a bull flag. So let's say you buy here and you get follow through, maybe you add a little through the bull flag breakout, but the actual outside reversal pivot is right here.
Perfect. Yeah, I think that is good. I think we can move on.
Yeah. Okay. So the last thing, and then we'll take a break. Failures, traps, shakeouts. This is not like a pattern per se, but when you're analyzing bases, usually bigger bases, well, actually all bases, flags, etc. But the more pronounced shakeouts are in these bigger bases. The more shakeouts at the lows of a base, the closer you may be getting to an upside move. So I think when you see big bases, if you don't see shakeouts, it's almost like, oh, it might not be ready. Because a lot of the times these big bases, like I feel like the institutions want to shake it out before it goes. But the reason the shakeouts matter is it shows institutional demand. So think about this level here in Teladoc, pretty big level. Everybody can see it. And we take out these lows and it looks nasty, right? Like we have a big gap down. It looks nasty. Like me, I am like probably in bear mode here, like get me away from this thing, because that's how I am. But what happens? We don't push lower. It shows somebody. I don't need to know who. I don't care. But somebody supports this stock and brings it back higher, right? But there's no tight pattern here. There's nothing to buy. But we're kind of getting support here on the 200 SMA. And then what happens here? We get another shakeout. Obviously, it's not the same as this, but this is another shakeout on this 200 SMA. And then to me, you do kind of get a buy area right here on this little kind of flaggish mini channel. And I actually took this trade right here, and it failed, and I got stopped out. And then we have another little kind of mini channel with really a third kind of mini shakeout. You notice the shakeouts get like less pronounced as we go along. But then when we break out of this little channel, this actually leads to a 50% move from 200 to 300. We clear this trend line, 3 touches, 1, 2, 3, 4 actually, and on the 5th touch we really blow. But when you start to see these shakeouts, you can kind of feel like, hey, there's this thing's getting more and more sold out, and that sellers can't break it, and eventually when it breaks to the upside, it could be ready to move. So this isn't a pattern or anything. It's just something to look for when you're looking at these bigger bases. Failures to the downside, traps, if you will, shakeouts. And likewise, when you have an extended stock, when it fails to the upside, it could be a sign to start to take profits.
100%. And Ashwin had a good spot here. This is pretty much a 2B reversal double bottom here in the overall chart pattern. Especially if you look at a weekly, this will clearly look like a double bottom.
Exactly. And if you go back and watch like my interview with Richard, I don't know, the beginning of the year, I actually talked about this on the weekly and the monthly and how it showed that exactly.
Perfect. There's a question here. TDOC seems to be in an uptrend when it starts basing. How do you? I'm not quite sure if I understand your question. So maybe Vikram, you could rephrase that. Let's see. I'm not seeing any other specific questions. Here's a good one. Would it still be a shakeout if a stock gaps down on earnings like UPST just did?
UPST just looks like a monster gap down.
Yeah.
I mean, there's been no shakeout until UPST comes back up into its base. It's just been a nasty gap down. It remains to be seen if that's going to be a shakeout or not. I'm not sure.
Yeah, we have to see whether institutions bid it back up into the base before we can call it a shakeout, and for sure. Okay, I think. Did you have anything you wanted to add there, or?
I would just say, so like UPST. Remember my example earlier where I said that veteran trader told me, if the stock's gonna go up 10x, it's okay to wait for it. That's kind of how I view UPST here. Like I think UPST is actually in an area right here where you could maybe have tried to buy some Friday, on a lower time frame pattern, just because the risk is so low if you can find a low risk spot. But there's probably better opportunities right now, and if it's gonna be the 1,000